At 68, I think about money very differently than I did at 40. At 40, I could afford to be wrong. That is the privilege of youth. If I bought the wrong stock, I had time. If I chased a fad and it blew up, I had time. If the market cut me in half, I had time. Time was the asset behind every mistake. After 60, time stops behaving like an endless backstop. That is the first thing people need to understand. The rules change, not a little, completely. At that stage, your job is no longer to get rich. Your job is to stay rich. Your job is to protect the capital that took decades to build. Your job is to turn a lifetime of effort into durable income without putting the entire machine back on the operating table every time Wall Street invents a new obsession. That is the frame. And if you miss that frame, every decision after it starts leaning the wrong way. A lot of people over 60 still invest as if they are 35 with a strong paycheck and a long runway. That is one of the most expensive mistakes in finance. They still chase upside the way younger investors do. They still treat volatility like a temporary inconvenience rather than a permanent threat to lifestyle. They still listen to people who talk about wealth building when the real subject should be wealth defense. Those are not the same game. And if you play the wrong game at the wrong age, the penalty is brutal because the market does not care whether you intended to recover later. Later is not always available. So when I talk about safety now, I want to be very clear. I am not talking about fantasy. There is no such thing as a perfectly safe investment. Cash is not safe. It gets eaten by inflation. Government bonds are not automatically safe. They can be marked down hard when rates rise. Stocks are not safe. Even the best business in the world can get hit in a panic if enough people need liquidity at the same time. So let us drop the childish language. Safe does not mean immune. Safe means suitable. Safe means durable. Safe means it can preserve capital, throw off income, and survive long enough through real economic cycles that a retiree does not have to rebuild his life every time the financial weather turns ugly. That is what I mean by safe. And when you define safety correctly, the list gets very short. Not 100 ideas, not 10. Three categories that actually deserve the word more than the rest when you are over 60, and the mission has changed from expansion to preservation. The first is inflation-protected treasury exposure. The second is high-grade corporate credit. The third is high-quality dividend-paying businesses with defensive characteristics. That is it. Not because other assets can never work, because these three do the job you need done at this stage of life. They preserve, they pay, they endure. Now let me take them one by one. The first truly safe category for people over 60 is treasury inflation, protected securities, TIPS. I can already hear the complaint. They are boring. Exactly, that is the point. Boring is beautiful when the mission is survival. Predictable is beautiful when the mission is sleep. You do not need your retirement foundation to be exciting. You need it to be there when everything else is acting dramatic. That is what TIPS are for. They are the asset I think of as anti-decay paper. Not because they are magical, because they solve the most boring problem in retirement, which is usually the one that kills people slowly. Inflation is not a headline to retirees. It is a predator. It is the thing that quietly halves purchasing power while your account statements still make you feel civilized. If inflation runs 3% long enough, the damage compounds the way a cancer does, quietly and then all at once. You may think you are stable because the numbers in your accounts look roughly the same, but the groceries, the electricity, the home insurance, the prescription costs, the restaurant prices, the travel costs, all of it is moving against you. That is why I say inflation is the silent killer of retirement plans. Retirees do not usually get destroyed by one dramatic event. They get dissolved by erosion. TIPS address that directly. The principal adjusts with inflation. That means your base rises when prices rise. If the CPI rises 3%, your principal rises 3%. If inflation jumps, your principal rises with it. No, it is not perfect. No, it does not make you rich. No, it does not give you cocktail party bragging rights. What it does is something far more valuable than bragging rights. It preserves purchasing power. That is the center of retirement safety, because once you are living off your money instead of building the pile, the true question is not, how big is my number? The true question is, what can my money still buy me 10, 15, 20 years from now? That is the only honest way to frame it. And right now, the useful thing about TIPS is that you can actually get real yield for years. They were less attractive because real yields were thin or even negative in some stretches. You were accepting inflation protection, but not much real return. Today, the math is better. That matters. Because if I can get inflation protection plus a positive real yield, I have something retirees desperately need. A floor, not a fantasy. A floor That is why I think tips should be a major foundation in a retirement portfolio. Not the whole thing, but a major foundation depending on the rest of your life, your pension situation, your Social Security, your withdrawal needs, your temperament. That foundation might be 40%, it might be 50%, it might be 60%. The exact number is less important than the principle. A retiree needs a serious block of assets whose primary job is not to impress anyone. Its job is to keep the bottom from falling out. That is tips. Now let me move to the second category, high-grade corporate bonds. This is where people make their first big mistake. They hear bond and immediately go hunting for yield. That is where retirees start stepping on landmines. The retirement brain sees 3% and feels disappointed. Then it sees 7% somewhere else and feels clever. That is how people get ruined. They stop asking what the yield means and start asking only how much bigger it is than the safe option. That is not investing. That is seduction. High-grade corporate bonds matter because they sit in a useful middle ground. They are not as pristine as government debt. But if you stick to truly strong issuers, they can give you additional income without forcing you into garbage. That is the difference. I am not talking about junk bonds. I am not talking about weak balance sheets wrapped in attractive coupons. I am talking about lending to businesses so durable and financially strong that the probability of catastrophic credit failure remains very low. Think about businesses that make real money every year through cycles. Businesses with fortress balance sheets, businesses with dominant market positions, businesses with products or services people keep paying for, recession or not. That is the kind of bond exposure I want retirees to own. Why? Because retirement is partly an income engineering problem. You have essential expenses, you have a standard of living, you have real-world obligations. So the portfolio cannot just be theoretically safe, it has to pay. This is why high-grade corporate bonds deserve a seat. They add income over government paper, not by performing a miracle, by taking a modest, controlled, understandable increase in credit risk in exchange for a better stream of cash flow. That is a rational trade when it is done selectively, but only selectively. That word matters. A lot of retirees who reach for yield do it because they think bond investing is about finding the highest number. It is not. Bond investing, especially in retirement, is first about getting repaid. Yield comes second. A bond that pays 8% and blows up is not an 8% bond. It is a trap. A bond that pays 5% and quietly returns principal while sending cash every period is a beautiful thing when your main goal is maintaining a life rather than winning a spreadsheet contest. Now people will say, what about interest rate risk? Fair question. Yes, if interest rates rise, bond prices fall. That is how math works. But here is the key distinction retirees need to keep straight. If you own high-grade corporate bonds and plan to hold them to maturity, market price fluctuations matter less than people think. The income still comes, the principal, assuming the issuer remains healthy, still comes back at maturity. That is the benefit of matching asset design to retirement needs. You are not forced to think like a trader. You can think like a lender. That mindset is healthier. And because it is healthier, it tends to produce better behavior. Retirees lose a lot of money, not because markets are impossible, but because they keep treating long-duration financial decisions like short-term opinion polls. Every day they check the mark to market price as if the bond's purpose was to entertain them. Number, the purpose is to pay you. That is why I like high-grade corporate credit as the second leg. Not for drama, for income, for reliability, for structure. Now we come to the third category, dividend-paying stocks from high-quality defensive businesses. This is where people get uncomfortable because they hear stocks and think, you just said safety. Yes, I did, and I mean it, because not all equity is the same. Most people talk about stocks as if they are one giant undifferentiated casino. That is lazy. Owning a speculative software company with no earnings, no dividend, and a hope-based valuation is not the same as owning a dominant consumer staples business that has paid and raised dividends across wars, recessions, inflation waves, and political stupidity for decades. Those are not cousins. They are strangers. The type of stock that belongs in a retirement safety bucket is not a concept stock. It is a cash machine. It is a company that does essential, repeatable, durable business utilities. Consumer staples, certain healthcare names, certain defensive infrastructure, like businesses. The kind of companies people keep paying regardless of whether the economy feels wonderful or miserable that matters. Retirees need stocks for two reasons. First, income. Second, inflation defense. The income side is obvious. Dividends are cash, they show up, they matter, they can supplement bond income, they can create breathing room in years when other portfolio pieces are under pressure. But the inflation defense side is just as important. A good business can raise prices. That is one of the few defenses against a declining currency. A government bond gives you a contract. A high-quality business gives you a living mechanism. If the costs of inputs rise, a company with pricing power can often pass some of that through. If nominal growth rises, earnings can adjust. If inflation becomes stickier than expected, a dividend. Paying business with real products and customer loyalty can protect you in a way a fixed nominal promise cannot. This is why retirees should not try to live on bonds alone. That can feel safe for a while. Then inflation reminds you that fixed nominal streams are not the same as living cash flows attached to adaptable businesses. Now, let me be disciplined again. Dividend stocks are not immune to drawdowns. In panics, they can fall. Utilities can get hit. Consumer staples can get hit. Healthcare can get hit. Everything can get hit. But there is a huge difference between a temporary drawdown in a high-quality defensive dividend payer and permanent impairment in a speculative growth name. The high-quality business keeps operating. The dividend often keeps coming. The fundamental machine stays intact. That is the distinction that matters. If you own the right kind of business and you are not forced to sell in the middle of a panic, time usually repairs the mark to market damage. That is why income matters so much in retirement. Income gives you patience. Patience protects returns. Now let me tell you what destroys retirees most often. It is not usually one bad investment. It is not usually one crooked advisor. It is not usually one market crash. It is behavior. Specifically, 5 kinds of bad behavior. The first is reaching for yield. This one is the killer. It looks so innocent. Rates are low. Expenses are real. You want a little more income. You see something paying 7%, 8%, 9%. You tell yourself, just this small slice. Then you realize later that the reason it paid 9% is because the market knew something you did not. Retirees love the idea of income. They should. But they must learn the rule that governs all retirement income investing. The more tempting the yield, the more suspicious you should become. Not excited suspicious, because the market is not in the business of handing free lunches to retirees. High yield is usually the market's way of saying, danger lives here. The second mistake is market timing. This one never dies because people never stop believing. They are smarter in the next cycle than they were in the last one. Retirees especially fall into this because they feel they cannot afford another drawdown. So they begin telling themselves they will protect themselves by getting out and then buying back in later. That almost always turns into this. They sell after pain. They wait for clarity. Clarity arrives after the rebound. Then they hesitate because the market already moved. Then they buy back in higher. That is how timing destroys capital. It gives emotional relief in the moment and poor math over time. The third mistake is overconfidence. This one is common among successful professionals. Surgeons, executives, business owners, engineers, lawyers, they are used to being competent, decisive, and well rewarded for judgment in their own domain. Then they bring that confidence into markets and start acting as if success in one field automatically translates into public market skill. It does not. Running a company and valuing a stock are not the same thing. Being brilliant at medicine does not make you good at credit analysis. Being brilliant at engineering does not make you good at asset allocation. That is why I always tell people this. Do not let career competence mutate into investment arrogance. It is expensive. The fourth mistake is concentration without understanding. A lot of retirees are far too concentrated in the stock of the company they worked for, or in one sector they think they understand, or in one country because it feels familiar. Familiarity is not safety. That sentence should be tattooed on a lot of portfolios. Proper diversification matters more over 60, not less. Because once time stops being your infinite safety net, you need multiple engines in the boat. You need assets that respond differently to different environments. The fifth mistake is tax blindness. This is one most retirees ignore until it is too late. Retirement changes the tax picture. Income streams change, withdrawal patterns change, IRA distributions matter. Roth conversion windows may matter. The difference between what you hold in taxable accounts and tax-deferred accounts matters. A retiree who ignores taxes is like a sailor who ignores currents. He may still be moving, but not where he thinks. Now let me turn to the bigger structural risks retirees face, because these shape why I prefer these three categories so strongly. The first is inflation. I do not think the world is going back to the kind of clean, low friction, low inflation environment people got used to in certain stretches of the last few decades. Too much debt, too many demographics pushing the wrong way, too much political dependence on fiscal largesse, too much deglobalization, too much strategic nationalism, too much weaponization of currencies and supply chains. This does not mean every year will look like a crisis year. It means the probability of structurally higher inflation is not trivial anymore. That is why tips matter. That is why dividend payers matter. That is why fixed nominal thinking is dangerous. The second major risk is longevity. This one is easy to discuss and hard to emotionally price. A healthy 65-year-old today has a reasonable chance of living into the 90s. That means your portfolio may need to keep functioning for 3 decades. 3 decades is long enough for inflation to do major damage. 3 decades is long enough for 1 or 2 serious bear markets. 3 decades is long enough for a bad withdrawal strategy to quietly become a catastrophe. That is why safety at 65 cannot mean no volatility this year. Safety has to mean durable purchasing power over a very long runway. That is much harder. The third major risk is healthcare. This one is the great destroyer of elegant plans. Healthcare inflation is not polite. Long-term care risk is not polite. Late life medical costs can tear through retirement assumptions with very little warning. That is why I prefer retirees to think in layers. Not one giant withdrawal pool. Not one giant optimism number. Layers, a survival layer, a lifestyle layer, a flexibility layer, a healthcare reserve layer. That is how adults plan. Now, let me give you the implementation framework, because this matters more than people think. First, figure out your survival budget, not your dream budget. Not your travel fantasy, your survival budget, housing, food, utilities, insurance, healthcare, transportation, the things that keep life stable and dignified. That number is sacred. That number should be covered by your safest and most predictable portfolio cash flow. This is where tips and high-grade corporate bonds do the heavy lifting. You do not want your basic life depending on whether the Nasdaq had a bad quarter. Second, separate the lifestyle budget from the survival budget. Travel, entertainment, gifts, experiences, optional generosity. Those things matter. Life should not become joyless because you turn 65. But the source of funding for them can be allowed a little more variability. That is where the dividend stock layer helps. That is where additional income from the portfolio can stretch lifestyle without endangering shelter. Third, keep real liquidity. Not excessive cash rotting in a checking account, but enough true liquidity for emergencies and flexibility. 6 to 12 months of expenses in something. Liquid and safe is not laziness. It is wisdom. Liquidity buys peace. Peace improves behavior. Fourth, rebalance. Rebalancing is one of the simplest intelligent acts in finance and one of the least emotionally pleasant. When stocks run, you trim some and feed the bond side. When bonds outperform, you restore balance the other way. That discipline keeps your allocation honest. It forces you to sell what became expensive and buy what became relatively cheap without requiring prophecy. That matters. Fifth, know your withdrawal rate. The old 4% rule became gospel because people love one clean number. Life is not a clean number. I prefer retirees to think more conservatively. 3 to 3.5% is a healthier place to start for many people in today's environment, especially if they want durability, sleep, and room for inflation surprises. Could reality be kinder? Yes. Could a portfolio support more? Sometimes. But retirees should begin with humility, not with hope. Now let me say the last thing clearly. These 3 categories are not sexy. That is why they work. Everyone wants a miracle stock. Everyone wants a hidden asset. Everyone wants to believe the next hot idea can do all the work that discipline is supposed to do. That is not how retirement safety works. Retirement safety works when the portfolio is built to survive boredom, inflation, time, and human weakness. That is what tips do. That is what high-grade corporate bonds do. That is what quality dividend payers do. They will not get you invited onto television to talk about your genius. They will not make your nephew call you a legend at Thanksgiving because you bought the right token. They will do something much more valuable. They will let you sleep. They will let you pay the bills. They will let you maintain dignity. They will let you live from your capital without gambling that capital every quarter. That is the actual definition of success after 60. Not maximum return, not excitement, not brilliance, durability, income, preservation. And if you can keep those three words at the center of your portfolio, you will make fewer stupid decisions than the average retiree, and over a long enough stretch that alone will look like brilliance, because the later game is not won by the most aggressive player. It is won by the player who stays on the board long enough, comfortably enough, and sanely enough that he never has to trade his future for one more thrilling story. That is the only kind of safety that matters, and these three categories get you as close to it as real markets allow.